Hello and welcome to topic 47, tax reduction management techniques. I hope several of you will find this useful, as most of us do not like to pay any more taxes than we have to, and we should be looking not only for ourselves but for our clients, tax reduction techniques. So some of the items that we're going to be discussing are income shifting, maybe deduction clustering, possibly deferring some income, maybe use of a tax preferenced account for certain items, and then investment strategies so that we're also managing our tax liability. So let's start with income shifting. This is where we shift taxation to a family member in the lowest tax bracket so as to reduce the overall taxation for the family unit as a whole. So we hire family members to work in the family business. That would be a kiddie tax. Does not apply to earned income. So we'll talk about that. But we transfer ownership of income producing assets to the lower bracket family members. And this is a usefulness, but it can be limited to the kiddie tax. So even though we're trying to do income shifting, we have to be careful with the kiddie tax. Then we might want to shift some family business assets through gift or sale or leaseback. Gifts have certain limitations. Or we might want to just do an intra-family transfer of some business ownerships, and then we're going to talk about that in a later class. Then we might want to do deduction clustering. So here we take the standard deduction in one year and then we cluster itemized deductions together the following year. So for example, an unmarried couple with disproportionate incomes. So the lower earning client takes the standard deduction while the itemized deductions are shifted to the higher earning taxpayer. You might find this when two spouses work, but their incomes are so different. So the higher earning and the higher paying tax person would take the itemized deductions and then the standard deductions by like the lower earning spouse. So business and rental expenditures can be delayed and clustered into a tax year where the income is higher. So those are just some of the things we can do all within tax rules to hopefully give us more deductions. We can defer income. Basically what I've seen is non-qualified deferred compensation plans. Those are common, and several smaller companies establish that just to give their top management or VPs, CFOs, CEOs the ability to do that. A lot of retirement plans, right, allow you to do that. You might defer selling some investments until later years, or you might defer billing if you have cash basis clients. You just have to be careful with that with some accounting rules. You can defer year-end bonuses, so if and then you might give it in the following year just to have that deduction in that year. Incentive stock options, and then earnings on annuities. But I would say retirement plans and non-qualified deferred compensation plans are the most common. Then you might want to use tax preferenced accounts like Roth IRAs or some traditional IRAs, maybe qualified retirement plans, maybe flexible spending accounts, FSAs. You might also want to use Section 529 plans to pay for college education or other, educational savings accounts. So that just kind of gives it to you pre-tax. If you have those situations, you might want to look at them. Then you might want to have your investment strategy so that you're not only trying to maximize your income, but also minimize your tax liability. So you might have some tax loss harvesting. You might want to manage your capital gains. Maybe you have a lot of qualified dividends that you have to pay. You might want to spread them over a few years. You might have some bond swaps, some passive income generators. So you just want to be careful when you do have those, because that might bring up some additional tax stipulations. And that pretty much covers our whole bit on just some tax saving strategies. So that concludes this video lecture.